Hey, good afternoon for those of you who are in the Eastern time zone. I am David Dietze. I am proud to be managing principal, senior portfolio strategist at Peapack Private Wealth Management. Here in Summit, we're managing over $400 million on behalf of about 200 clients. We are so excited to be talking about what's ahead for 2021 in terms of your portfolio, in terms of the economy, in terms of everything else that's connected with that. So we've got about 30 to 35 minutes of text. Who's we? Let me get right to my partner in crime here, who's going to help me cover this immense topic. That would be Fritz Schoenhut. Who's Fritz? Well, it's so good that Fritz found us. He right now is managing director and portfolio manager with Peapack Private. But of course, he came to us not that long ago from Goldman Sachs, where he was the so-called main point of contact for his team's ultra high net worth and institutional clients. Thank God. Back then, he wouldn't have even taken my phone call. Now he's working with me. Anyway, he was the primary relationship manager and did investment matters, portfolio allocation changes. And also, Fritz is a tax guy too. Before he got to Goldman, he was a tax associate at Grant Thornton. He is the proud holder of a bachelor's degree in finance from Notre Dame, 2011, a young guy, and also has a degree in taxation from Baruch in New York, and also a chartered financial analyst. So he's going to help me go through this topic. A couple other housekeeping matters. One is we've got a poll. Down below, you should see, we are asking you as to what your biggest concern is as we head into and go through 2021. We've got 5 choices for you: interest rates, inflation, valuations, and geopolitics. And if it's a little bit of all of the above or none of the above, you always got other as a choice. And we'll be telling you at the end how all that worked out. Finally, as housekeeping, you will notice, hopefully, at the bottom of your screen, a Q&A tab. What's that mean? That means that during the course of this presentation and at any time, including at the end, we want to take your questions. Really, the most interesting and meat of it is not what we tell you, but it's what you ask us. So use that tab and type in a question, and we will answer that at the end. So I think with those housekeeping arrangements done, we can flip to our first page here. Okay, great. So we mentioned Peapack Private Wealth. Well, you know, we weren't always part of Peapack Private Wealth. We were honored to join them September 1, 2019. We've been managing money here in Summit, New Jersey since 1993, formerly under Point View Wealth Management. So why do we love what we do, and why do we think that we're doing the right thing for our clients? First of all, we adhere to the highest fiduciary standards. Trust is always so important. It's so much about putting the client first. Second, everything we do here is customized. It's not whatever steak we bring out on the table, it's how you want it. And so we're looking at customizing investment portfolios, but also holistic financial planning. Thank goodness we have Claire Toth down the hall, tax attorney with over 3 decades experience, helping us, giving us the supervision to make sure that what you make is as much as possible what you keep. We're also big in terms of parting company with the competition because we go directly to stocks and bonds. We don't take your money and then put it into funds or with other fund managers and let them do the heavy lifting. Why? Sidestep a whole nother level of fees. Transparency, avoid duplication, and just as importantly, keep the control of the positions manageable from a tax point of view. $1 million relationship management, it's basically a 1% management fee to retain us, but that does dip down as higher amounts are entrusted to us. All of our assets are custodied at Fidelity Investment for the utmost in security and protection. Next. Here's our team. right here in beautiful downtown Summit, New Jersey. You can see the good-looking people are not on the webinar, unfortunately. Well, other perhaps than Fritz, but we got a great crew of other portfolio managers and client service representatives that we're honored to work with. Next. So, before we can, focus on what we're going to expect, let's just take a look at what just passed. And 2020 was a year like no other. We came into the year with record high markets and everything looked good, and we promptly plunged into the worst pandemic since 1918. Markets dropped close to 35% in the shortest period ever on record. And of course, we knew nothing about what would happen. What did we do here at Peapack? Well, we basically rebalanced, stayed the course, and said this will get better. Fortunately, we had some big assistance, which was the form of stimulus from the government. That took the nature of the Federal Reserve forcing interest rates down to as low as they were in the subprime crisis, dusting off that playbook from back then and starting to buy everything in sight in the credit market so that the health crisis did not turn into a financial crisis. And that helped the markets turn right around. There was no retest of the bottom. It was a V-shaped recovery. But of course, they had a lot of help from Congress, who promptly passed 5 stimulus packages totaling trillions if you add it all up from March. And why was the government so generous? Unlike the subprime crisis situation, there were no bad guys. Remember back then, it's like, well, should we help the banksters? Didn't they kind of create this thing by investing too much in risky mortgages, and they tried to make a lot, and now they want help? But in the healthcare crisis, no one was a bad guy, and government officials did not want anyone to lose out for no reason of their own. Of course, there's other stuff going on that made it a volatile year. We saw the very sad events involving the George Floyd killing and the ensuing activity. Of course, at the same time, we're juggling with an election. Would Trump have a second term or not? For the most part, our clients and most of America thought Trump would repeat, but that's not what happened. Of course, Wall Street promptly told us not to worry if there's a blue wave because, well, we're going to get a lot of stimulus and so forth. And then, of course, it was left with the Senate staying Republican. And then, of course, that changed into a dead heat, save for the vice president's potential tie-breaking vote following the Georgia runoff on January 5th. And the Dems took both of those seats. So we've got a situation where it's a not blue tidal wave, but kind of a blue ripple. And that's what we have here. So now, next. Looking at what stocks did, who would have thunk with the worst pandemic since 1918, you would actually have an above average year. And if you look at the numbers, the S&P 500, probably your broadest measure of American stocks, although it plunged 35% in March, it soared 68% following that. So even though the average annual return for the stock market is just under 10%, it was actually over 16% for the full year, and indeed more than a full year's return just in Q4, up 12%. Of course, there's winners and those who are very much runners-up. The NASDAQ was the big winner, 43.6% for the year, as some of those technology companies, which allowed us to stay more productive when we were at home, did not skip a beat. In fact, they got more business as people tried to figure out how they could interact and stay productive when they weren't at the office. That was up 43%. The Dow, which had more cyclical stocks, only up 7.3%, but showed some of its mettle in Q4, up 10%. There's a big disparity. There is really a tale of two markets. Growth stocks, those stocks which trade at pricier levels, but perhaps have more juice going down the road in terms of growth, up 38%. And value stocks, which include things that pay hefty dividends, are trading at lower price to earnings ratio, was only up 2%. For a long time, small stocks were really down in the dumps. I mean, small stocks is almost a reflection of what we saw in Main Street, where Main Street was totally locked down. But then as there were signs of the vaccines coming down the pike, the Russell 2000, which is a good barometer of small stocks, took off. And indeed, that ended up outpacing the S&P 500 with the larger stocks, with the Russell 2000 up 20%. Overseas stocks lagged. They had less technology as a general proposition in those indices, up 8%. Emerging markets did well, actually beat our own market. Partly is because 44% of emerging markets were China, first one in the pandemic, first out, and therefore their stock market did well. Next. So, really with the interest rates being pushed down to record low levels, everything that moved, people were starting to throw money at. Example, commodities, gold, and Bitcoin rally. Part of the gold and Bitcoin story was weakness in the dollar, which we'll talk about in a moment here. But basically, gold had its best yearly performance in 8 years, actually beating the S&P 500, even though it doesn't pay any income. Bitcoin, as it gained greater institutional acceptance, up 400%. Commodities were strong. Copper was up 26%. And that kind of bodes well for 2021. Often they call it copper, Dr. Copper. Why? It has a great record of forecasting the economy. So it's a little bit like an economist, but maybe even more accurate than some of the academic economists. Next. So, what didn't work out so well? Well, if you stayed in cash, you were safe, but you didn't make anything because the interest rates were pushed right down to zero. And the Fidelity Money Market Fund, where our clients keep their accounts, 1/100th of 1%. And given inflation approaching 2%, that's a pretty ugly negative real return after inflation. Dollar fell 8% last year, 12% since March. With the interest rates lower here, a lot of people left the United States. There's also concerns as to whether we were handling the pandemic as well as, for example, China, Japan, and Europe. But, at the end of the day, we're such a big economy. We're our own planet, as it were. Policymakers don't really seem to care. We'll see what happens going forward here. Next. But there were whole swaths of the market failed to participate. And ultimately, we're going to get to this. That may be your opportunity for 2021. Believe it or not, there's 500 stocks in the S&P 500. 200 of them, or 40%, lost money last year. So there's 200 companies, which if you ask them, the people that run the companies, are you overpriced? You know what they're going to tell you. Again, we talked about the growth stocks dramatically outperforming value, which meant value went nowhere. And maybe it's time, and maybe we're already seeing value starting to pick up the pace. Energy stocks were the biggest losers. I mean, how many of us kept that car in our garage and just didn't use it except for basic necessities? No one went traveling on Thanksgiving. And of course, all those airplanes, no one wanted to get on them. No one wanted to go to the airport. They're all on tarmacs in some place in California. So that meant they didn't need fuel. Financials did poorly too. Why? With interest rates so low, their number one product is a loan, like a loan to allow you to buy a house. But if those interest rates are low, they're getting lost for those loans. Utilities and REITs didn't do all that well either. Well, people told the utilities, if someone can't pay their bill, don't turn off the power. If someone can't pay the rent, you can't evict them. And that weighed on utilities and REITs. Interestingly enough, one of the best strategies over the years has been the dividend aristocrats. Well, what are the dividend aristocrats? Those are those S&P 500 companies which have cranked up their dividend, not just once, twice, but every year for at least 25 years. But people didn't appreciate that last year, partly because they weren't, the new age technology stocks, partly because there were fears of dividend cuts. Next. So, what did we learn from last year? One is, don't try and time the market. No one gets out at the top, gets in at the bottom to try and guess the twists and turns of the pandemic, and then to overlay that, what the policymakers' response were. That's really a mug's game. Second thing is, even when the world looks like it's going to fall off the cliff, never underestimate the power of the printing press and deficit spending, and that's definitely what we saw. Certainly, rebalancing was a great technique. Basically, when stocks become a smaller portion of your portfolio because of the sell-off, then shift enough from cash and fixed income into stocks to get back up to your target and then take advantage of the rebound. That worked so well last year. And although a lot of airtime and chat time was spent on talking about who was going to win the election and what the other guy would mean, the fact of the matter is this market and this economy powered right past all of that. Next. So, where are we going to be going next year? Basically, remember, no one really knows for sure. No one predicted last year. No one for sure has this year knocked, but 2/3 of the time, actually more than that, 72% of all years, it's an up year. And, actually, historically, 81% of those years where it's the first year of a new presidency are up years. So that basically means is, there's reason to see things half full, if not a little bit more. But look, unfortunately, we have not seen, is my prediction, I'll tell you right now, the low point in this market for the year. Typically, stocks correct 10% at least once each year, and a 5% correction happens up to 3 times a year. So always keep your seat belts fastened. What's going to really drive it? What's going to drive it is going to be these vaccines, because at the end of the day, we can't keep printing money or spending money we don't have that's going to cure an economy where people are afraid to get out of their basement. But the good news is we've got Pfizer, we've got Moderna, J&J is on the way, Novavax as well. We think that by mid-year, there's a chance that the country will develop herd immunity, allowing the bulk of the American people to re-engage, which will be good news. Next. So after that, it's all about the ultra low interest rates. Well, even as Janet Yellen said the other day, of course we're going to spend money. It costs nothing to borrow. Interest rates are so low. And so, of course, people are going to be buying stocks because they're getting 1/100th of 1% in the money market fund. Interest rates are so low. A key metric or comparison is the yield on the S&P 500, which is now about 1.6% versus the yield on the 10-year Treasury. Normally, the 10-year Treasury is more. Right now, the 10-year Treasury is only 1%. So the money's going to keep flowing in. The key thing that investors and everyone's got to think about is how long will that take? Well, the Fed has had an answer. It's going to be a long time the interest rates are low because they want to crank employment down as far get the unemployment rate as low as possible, and are willing to suffer higher inflation than normal, higher than 2% to get there, which means expect low interest rates for longer than we would otherwise have the case coming out of a downturn. Next. Of course, support of Washington is the next positive factor. At the end of the last term, we saw a $900 billion bill passed. The new President Biden wants it to be $1.9 billion, increasing stimulus checks from $600 per family up to $1,400. We'll see, but certainly those are bullish factors for the market. Next. Of course, there's always risks. I think if the healthcare and the pandemic was the big problem last year, any problems with the vaccines is going to cause a pause in the market. From my point of view, I think we can ultimately get the delivery and efficiency knocked. What I worry about is mutations. There are signs that in South Africa, there's a mutation that perhaps isn't handled by the current vaccines. We'll see, but that's something we've got to be watching. Obviously, until that economy reopens, there's job weakness, there's economic weakness. That's not good for corporate profits or stocks. Interest rates, if low interest rates is the reason for doing a lot, if interest rates start to rise and turn around, that could cause investors to rethink their approach. What could cause interest rates to rise? Inflation. We've seen 25% more dollars created in the last 9 months. Right now, that's sitting in bank accounts. If that all of a sudden that is spent and we see prices moving quickly, that will cause the Federal Reserve to rethink their low interest rate policy. Another thing that could cause inflation is if our dollar goes down in value. Obviously, we're looking at the outlook for higher taxes and more regulation. And right now, from a contrarian perspective, it's kind of a negative that everyone's so enthusiastic, because that enthusiasm breeds high prices. We like to buy when prices are a little bit cheaper. Next. In terms of that over enthusiasm, you can see how, although bearishness exceeded bullishness for most of last year, that has changed. And as we look at the saga of, for example, GameStop and see what some of the retail investors are doing, that's a cautionary sign going forward here. Next. People ask us all the time, what's going to happen because there's a change in administration? And quite frankly, markets do well no matter who's in the White House. But when you really look at how the market's done since the 1926, it's actually done a little bit better when a Dem has been in the White House. Not sure why, but that's the reality for those partisans who would feel otherwise. And actually, a split government does best of all. Do we have a split government? Well, technically, no, because the vice president could cast a deciding vote for the Dems in the Senate. But it's given that it's 50-50 without her, it's certainly not a decisive blue wave situation. And historically, divided government produces better markets. So we'll watch that carefully. Next. So, in terms of the change in administration, you want to stay the course with your investments. It's always fun to talk about, well, the other guy is going to ruin the economy. The other guy is going to raise my taxes. The other guy is going to do this or that. Historically, making a change in your portfolio in response to those types of feelings, or who's ever in the White House, has not been a smart move. We have a nice quote here from Buffett on how he ignores all the politics when he is investing his great wealth. The fact of the matter is, investors need to have a long term. So quite frankly, you're going to go through, if you have a sufficiently long time horizon, many presidents. And of course, every 2 years, the House of Reps are for re-election. We're already in the countdown to the midterms, right? And of course, even if you had some insight as to what the guy in the White House is going to do, the fact of the matter is you have to wonder, well, is that what everyone else is thinking anyway? And therefore prices already reflect that. And of course, no matter what the promises are on the campaign trail, polls time and time again has said the number one issue for voters is the health of the economy. So they can talk about what they want to do, but if they don't get that economy going and they don't keep that stock market up, they may not get a second chance. So keep that in mind. At this point, you're going to hear from Fritz Schoenhut, and I turn the podium over to him.
Thank you very much, David. So now we'll go into a couple of things that we think are likely in the new administration and over the next several years. And so right off the bat here, we have infrastructure spending. And with the Democrats now with a majority in both houses of Congress and sitting in the White House, the odds of an infrastructure spending package is more likely. But with on the Republican side, there is significantly more likely to accept some sort of bigger spending package with the potential to increase taxes because of the need for spending and updating the roads and bridges and infrastructure around this country. And this really, it helps both parties. On the Democratic side, this has been, a big boost to blue collar workers, the traditional members of the Democratic base. And on the Republican side, the fears of inflation and higher interest rates haven't really been seen from some of the larger spending packages over just in 2020, but also, going back, the past 10 years. And so, the fear of any ramifications in regards to inflation and higher interest rates are certainly lower. Higher corporate taxes. So this was a key tenet of President Biden's platform, and certainly a big concern for the market, as higher corporate tax rates impact the earnings, the ultimate underlying earnings companies report, and therefore the valuation that investors place on their stock price. Now, if we recall back in 2017, the tax law change then reduced the corporate tax rate from 35% down to 21%, which then saw a big rise in the stock market in the following year. And in Biden's proposal, his is calling to bring that halfway back up to about 28%. And so while this would increase tax burden by about a quarter, it only reduced profits by 7%. And so with the Democratic sweep in Georgia, the likelihood of higher taxes, especially higher corporate taxes, has certainly increased, but it's definitely not a given the slim majority in the Senate. And additionally, this action of higher taxes in general would be like counter to what the Federal Reserve has indicated as their desire for more fiscal stimulus and not fiscal drag, of which taxes would be considered, especially coming out of the COVID pandemic. So additionally on taxes and more geared towards the individual investors, there is the thought that we might see some higher income and capital gains taxes. And so the president has made clear that his goal is to increase taxes on only those making more than $400,000 a year, and a higher capital gains tax rate roughly equal to the income tax rates for those making $1 million plus per year. And so we see that this is much more likely with the Georgia runoff. The view of taxing the higher earners and the one percenters is a little bit more palatable across the country. But again, this any form of taxation is considered more of a fiscal drag. And as we're trying to get the economy going again and start moving on all cylinders, the Fed has really been pushing for more fiscal stimulus rather than a focus on increasing taxes at this time. So as we now embark into 2021, what are some of the financial to-dos on our list? And so first and foremost, kind of looking back in 2020, I think the need to save and have that emergency fund and a cash, some sort of cash balance to weather you through some of the storms is certainly important. And so, our thoughts are just to really continue to save and automate it as much as possible. Additionally, fund to the max any 401ks and retirement accounts. Think very long term. We saw 2020, a lot of people were forced into retirement a bit earlier than they expected. And so having some sort of fund that has been growing tax-free for years is certainly a good thing to have. And just with some of the changes that we've seen from back in the CARES Act, the self-employed have some enhanced opportunities as well to set up retirement accounts. And so we would urge any self-employed people to take advantage of that. Pay down debt. If you have any higher outstanding debt, with rates so low, it makes sense to certainly pay off what you can. And along those same lines, refinance your mortgage. Oftentimes that's the biggest debt you have on your balance sheet, and with refinance rates still so low, you can end up saving quite a bit of money per month if you end up refinancing your mortgage. So this brings us into our investment strategy for 2021 in light of the new administration and kind of where we are in the economy. And so, right off the bat, and this is true at any point in time, not just in 2021, but it is to make sure that you are diversified. We've seen a big run up in tech stocks over the several years, but with the valuations where they are and with the potential, for any back up in interest rates, our recommendation is to stay diversified and kind of go with more of an equal weight strategy. Additionally, with any potential changes coming in the tax laws, we want to make sure that our investments are tax efficient, and it's important to consider how you allocate to equities and fixed income across your taxable and tax sheltered accounts. That's important. Think long term. David mentioned it, but also, not getting too focused on the headlines. I think CNBC does a pretty good job of, and they know what they're doing when they kind of flash in bright green and bright red, their headlines across their screen to get eyeballs. But really for longer term investors, it's important to kind of block out some of the headlines, some of the noise, and think very long term about the goals you have and how best to achieve them. Add cyclical value and dividend stocks to your portfolio. We'll be going through that shortly, but that is there's definitely some opportunities there. A caution on fixed income with rates so low and the potential for interest rates to rise. This could be a detriment to fixed income portfolios. Consider real estate asset investment trusts, REITs. And so, if there's any increase in the corporate tax rate, well, the taxable status of REITs actually allows them to sidestep those potential higher corporate tax rates, and they have traditionally higher dividend payments, and so these could be good alternatives to start looking where to get invested. Bitcoin and IPOs, we think, at this time, it's not a great investment strategy. They appear to be more of a trading strategy, and that's not really what we recommend for clients as they are, thinking how best to fund future college expenses or fund the life they want to have in retirement. So we generally are shying away from making those sorts of investments. And lastly, the concepts like DoorDash and EV and vaccines, there's a lot of themes out there. And it's important to kind of consider, the pros and cons of all of them before kind of going with the crowd. So cyclical value stocks have been long-term underperformers. And so as we see from this chart, especially, they've been underperforming, the growth side of the market, with the green line representing the Russell 3000 growth and the blue line being the Russell 3000 value. But historically, they have outperformed the market and growth stocks. And we've seen this reversal going back to September 2nd through the new year, where, the value stocks, the more economically sensitive, cyclical and financials and energy, they've outperformed their more tech-oriented growth stocks by about 7%. And we think that these sources of investments may be better positioned coming into 2021 to take advantage of any additional fiscal stimulus and infrastructure spending, really as the economy moves back towards normal and as there's more cash in the system and more focused on kind of getting the economy going. We think that we'll see a continuation of the trend. Dividend stocks due for a rebound, but will higher taxes spoil the party. And so historically, dividends have represented a pretty sizable proportion of total return. And more recently, though, as we've seen, investors have gravitated towards the growth stocks. And really that has been as a result of investors being a little bit more skeptical of the ability of companies to continue paying their dividends, especially in light of the 2020 COVID pandemic and companies, shuttering and laying off employees. There's a lot of concerns about cash flow. And so, our thoughts there are really, while the timing is always uncertain in terms of, certain investments being made, we think that the rationale behind the potential for positive performance going forward is still there. And one way that investors can take advantage of that is to look at the Dividend Aristocrats list as an initial screen. David had mentioned that before. And, our one caution would just be that, companies' dividends is typically a historical look, and it's not really a go forward. So we're not really sure what the catalyst might be for, any potential cuts to the dividend. So, you have to kind of weigh the pros and cons. Healthcare stocks. So traditionally, these have come under pressure around election time, as the two sides of our politics have really debated, especially in recent years, kind of the future of what healthcare looks like in America. And there's certainly a lot of concern about the efforts to rein in costs, whether it's through a single payer system or price controls, or permission to re-import from overseas. And so with all of that comes a lot of volatility in the space. However, we feel that there's this renewed respect for healthcare stocks and a lot of the big biotech firms as well, and pharmaceutical giants for their role in producing the COVID vaccines. And with Joe Biden as president, this indicates that the more progressive factions of the Democratic Party have not prevailed, leading us to think that healthcare may be a little bit more of a status quo than some major transformational change. And we always look to legendary investors such as Warren Buffett, and his Berkshire Hathaway has announced major stakes in Pfizer, Merck, and AbbVie. Tech stocks, too successful for their own good. So we all know that tech stocks soared in 2020 as the stay-at-home trade really took shape, but they've really been soaring for almost or a little over a decade now. But these secular trends have certainly accelerated through 2020 with that kind of shelter in place, quarantining, staying at home, the home office trade. However, as we've seen in recent months, especially here in the United States and overseas, a lot of the mega cap tech stocks are now facing some new battles or renewed battles, I should say, on a lot of the fronts that have been in the headlines in recent years, specifically regarding privacy and monopolistic behavior, and especially failure to police social media. And of course, over in Europe, there's the issues with the taxes and them not paying their fair share. So, all of these are potential major issues that these companies will need to face. And it really brings into question the valuations and how sustainable are they. So there's no doubt that tech is the future. And, the very nature of tech as the creative destruction, makes the duration of a tech product really open to questions. And at the bottom here, we say that, we'll be heating our homes with fossil fuels longer than we may be using the iPhone. That could certainly be the case. We never know, there could be a new phone company, in a year from now where that becomes all the rage. Or, we look at see how Tesla has kind of come into to form over the past couple of years. And so, it's always important, especially in tech, to understand the limitations of looking so far out in the future. So with that, that finishes up our presentation. Please certainly reach out to us for a replay of the webinar or a copy of the presentation, and certainly contact us to set up a complimentary meeting to discuss, review your finances and investments. So at this time, I'll bring it back over to David to go through some of the questions that we've received.
Hey, Fritz, great presentation. So this is actually, don't go anywhere, because this is actually the most interesting part, because we've gotten some great questions and we also want to review the poll results with you. We're going to kind of tag team this, but the first one, book value. Is it still a relevant valuation method? What's the market look like in terms of book value versus market value versus earnings? Is it different by sector? Well, so, our bias here is to use a classic valuation method, which looks at free cash flow. What are the profits that you can put in your pocket from a business, how much each year, and then discount them back to present value with an appropriate discount rate. The more certain are those cash flows, maybe you'd use a lower rate, and vice versa. So book value is an accounting method. Well, so book value may or may not give you a clue as to those future cash flows. So I do think that in certain sectors of the market where book value is so-called mark to market, where it's very current and somewhat liquid, it can be a good clue as to whether you have a value. So the one that comes right to mind, of course, is financial services. You've got all these loans on the books, and if the loans are worth X and the market value of the stock is X less 30%, you could argue that if you could liquidate that book of loans, you would have a difference of 30% versus what you're paying for the stock. So that's a sign of value. but in many of the new age sectors, it's not tangibles that they're focused on, but it's intangibles like patents, like developing a brand name. And so to the extent that the accountants treat expenditures for advertising and building up your profile as a current expense, but not a long-term asset, but we know it's going to create more cash flow down the road, book value is not a good measure. So I would have to say, to sum up, it's more important in financial services and perhaps real estate, less important in other types of like technology and certain consumer types of companies, and so therefore can't be relied upon exclusively. At this point, before we forget about it, Fritz, I would invite you to review our poll results.
So what is your biggest concern heading into 2021? Actually, 42% of viewers here say valuations. Another high one is geopolitics. We have at 23%, 13% at interest rates, 8% at inflation, and then 15% in other. So valuation seems to be on roughly a little more than 40% of people's minds.
Great. So we've got another question here. The green wave, the electrification of vehicles and associated businesses, batteries. What are we recommending? So I have to confess, we are cautious. Although we have no doubt that a decade from now, we're highly likely to be all driving electric cars. The question is, from an investor's point of view, are you going to make money? And my problem is when you look at the market valuation of the NIOs and the Teslas, and of course some of these electric trucks, and you put it all together, it's hard to see that there's going to be enough sales, even if everyone quickly flips over to electric vehicles, to justify those humongous valuations. There will be winners, but there's also going to be big losers. So how to play it? Well, we can't ignore it. What is interesting to us is some of the traditional vehicle makers, which actually have great divisions within their companies that are making substantial progress. Although we're not recommending any stocks on this program, as an example of what I'm talking about, look at General Motors with their Cruise division. In fact, they just recently hooked up with Microsoft. So there you have a traditional vehicle maker trading at a relatively low valuation relative to the markets, but with a potential group of vehicles, Hummers and Cadillacs and so forth, that will run via electricity, and I'm not sure investors are giving it proper credit. So that's possibly a way to look at that. Fritz, I'm going to give Fritz a question here. Emergency funds. Traditionally, how much should a person have on hand in terms of emergency fund? Traditionally, 3 months or 6 months. Has the pandemic changed your thinking? Fritz, go for it.
Yeah. So I think, first and foremost, I think that having an emergency fund is important, and it's ultimately what would help you sleep at night. That said, with cash rates so low, the 3 months, 6 months, that all sounds fine. I wouldn't necessarily go much more than that, because you're not really earning anything on it. But additionally, a lot of it has to do with, what's the size of your overall portfolio. If you have, let's just say you've got $100 million portfolio, there's reason to think that you may not need an emergency fund, because, with everything being very liquid, the odds of the 3 or 6 months not having that out of $100 million is pretty low. So a lot of it is just really dependent upon your personal situation and what helps you sleep at night. But certainly, I think in the 3 to 6 months still stands true. And so I guess I would leave it at that.
Okay. Great. Thank you so much. So we've got another question here. Is this the year for energy to come back? the one short answer is, to some extent, it's already come back. You've got, companies like Exxon, which are up since the election of around 40%, surpassing the return on, Apple computers. So there's already been a big rebound. Certainly, analysts have measured what they think is the expected rebound in earnings in 2020 versus 2020. And the energy cohort is expected to have, between 20 and 30% rebound in earnings. And to the extent that stock prices follow earnings, and to the extent it's not already reflected in some of that Q4 rebound, that would suggest yes. I think that my best paradigm is to think about what happened this past Thanksgiving. We all wanted to see grandma, the grandkids, go to Florida, get out of the house and be with others. But what did we do? We were all by ourselves. The car stayed in the garage. We didn't get plane tickets. There was no energy usage at all. Now, what do we want to do with Thanksgiving 2021? Well, with any luck at all, these vaccines are administered. We develop herd immunity. And I think that people will be itching to get out and travel. And that's going to be a big energy boost. And of course, manufacturing and other reasons, we think that demand comes back. Meanwhile, if you're an energy producer, after what you've been through over the last 18 months, are you likely to be able to get a loan from the bank to do more drilling? Less likely than it used to be. And so supply may be constrained, and that could lay the groundwork for higher energy prices and therefore higher energy stocks. So having some energy as part of a very diversified portfolio probably makes some sense here. Hey, Fritz, what's going to happen to muni bonds? We've got some financially challenged cities and states.
Yeah. So great question. We've seen, cities and states become incredibly financially challenged over the past year with the COVID pandemic, people not really moving around as much, and really putting a lot of resources into kind of the healthcare and everything on that front. And so, our view on munis is, we consider them to be, some great opportunities, really, because the cavalry is coming, and by that, a big portion of what President Biden is pushing for in his 1.9 trillion package is, funding for cities, states, and local municipalities. And so, in our view, as a long-term investor, there's certainly opportunities there. We're not necessarily shying away from muni bonds for fear of any widespread meltdown and in the credit worthiness of states and cities. But at the same time, our view in general on fixed income is a little bit more cautious. And so, we think that between a blend of muni bonds and equities and treasuries, that's the best approach to building out your portfolio. But in terms of any immediate concerns, we're not too concerned with muni bonds, given what is expected down the pike.
Awesome. So we're in all events, we're going to be done here at 2 because we want to be respectful of people's schedules. We've got 3 questions left. One, I'm going to punt on. There was a question on enhanced opportunities for the self-employed. And fortunately, Fritz and I don't have to be the expert on that, because we've got Claire Toth, who's going to have her own webinar that's going to focus exactly on that. Spoiler alert, basically you can put away and take off the tax grid a lot more money than you can in a traditional employment situation. But she will do a webinar which gets into the brass tacks on that. We've got a question on real estate buying, a question on international equities. I'm going to take the real estate. I'm going to warn Fritz, he's got the tough international equities question, and then we'll probably wrap up. But, so a lot of people are saying, gee, do you keep money in the market versus buying a property for a home given interest rate levels? Well, we have a bias here, of course. And of course, we've had a 12-year bull market, but we think, although it's not the most exciting thing to do, the more money you can keep in the market over the long haul, the more likely you're going to do. So our concerns, what are some of our concerns in terms of buying an investment property versus keeping money in the market? So, with the investment property, first of all, there is the diversification issue. So if someone has, $1 million portfolio and they say, oh, I find the perfect apartment to rent and it's 500,000, we're saying, hold it. If we put $500,000 into a single stock, you'd shoot us. You'd have half your portfolio in a single asset, natural events, problems with local jurisdictions and so forth, maintenance and so forth. That's risky to put that many eggs in one basket. So it's hard to get proper diversification for the average person to buy a home as an investment. Second, of course, is liquidity. Most of our clients, we set it up so that we can recreate their paycheck in retirement that they had while they were working. So with stocks, they're so liquid, we can slice off some shares of something that's overgrown a little bit, consolidate that with some dividends and interest is paid off, and send out that monthly check to them. But if you got a home, what happens if, let's suppose you're renting it, but for most homes today, it's hard to get more rent than the actual maintenance. But even if you do, what if you need a little bit more than your monthly cash flow? How do you chip off a portion of the porch in order to get a little spending money? It is illiquid. And of course, the beauty of the stock market now is our clients pay 99% of the time, 0 commission rate to trade in stocks. Well, real estate agents work hard. They deserve everything they can get. But if you're paying them, guess what? It's a lot more than 0. So there's a lot more transaction costs involved in trading in real estate. So those are some of the reasons why we tilt towards stocks rather than real estate for people's longer term savings. Now, at this point, Fritz, go with the international equities. What do you think about international equities versus domestic in terms of valuations?
Sure. And I guess just briefly touching on the poll question in terms of valuations, just to kind of get that one. Our thoughts on valuations currently, they're certainly high, but they're not nearly as high as we saw back in the .com era or .com years. And so there's some sense of relief there, but also, when we put it in context of, inflation and the low interest rate environment, we're not too far off from what is a little bit more of a normal, valuation relative to history. And certainly valuations, have shown to not be great indicators of when to exit the market. And so, our concerns with equities where we are now, we're certainly cautious. We're not advocating, selling or kind of trimming equities ahead of any potential, valuation meltdown. Now, in terms of how we're approaching international equities versus domestic equities, certainly, domestic equities at the industry level, at the market cap weighted level, definitely higher than international equities, where there's still, valuations are certainly lower. That said, though, and as David mentioned, there's a lot of opportunities out there if we look kind of beneath the hood, where stocks are still trading at significant undervaluations. But the same is said on the international side. There's some overvalued and some undervalued equities as well. And so our approach is really to as we're building out portfolios, making sure that we're diversified, across sectors, making sure we're diversified across regions, so U.S. and international, but always with a keen eye towards the valuations of companies and making sure we're not paying more than what we deem appropriate for any position. And so there's certainly a lot of opportunities on the international side that we do invest in international companies and that we are interested in. But so too are there opportunities still domestically, even if the broader index is trading at a bit more of a frothy valuation.
Great, Fritz. That sounds good. So at this point, we do want to thank everyone out there in the audience for taking the time to listen to us. We enjoy producing these webinars. Of course, we do have a slide deck. If you would like a copy of that, please give us a shout. Our contact information should be on your screen. If you'd ever want a complimentary consultation and talk about your situation, that's what we're here for. And until next time, Fritz and I bid you good afternoon. Thank you.